All right, cool. So, yeah, again, like I said, we're going to be talking about the power of three and really just learning to bridge this concept throughout your entire trading plan and really understanding that with trading ICT stuff, or really if you're trading price action, you have to understand that time is just as important as price. And the power of three is really the best way to relate the two. So, for those who don't know, the power of three is just saying that the market, and this is the essence of smart money concepts, right? Manipulation, right? That's what the overall, um, basis behind everything we do is. We're trying to track smart money's manipulation of the market. So, in order for there to be manipulation, there has to be accumulation, right? There has to be liquidity. So, for example, you know, if there's accumulation, right, it's going to be usually a sideways range, but sometimes it's not as clear as this. It's not just some picture perfect barcode, but you're basically just looking for liquidity to accumulate. That can be in the form of a pattern. It can be in the form of equal lows. It could be one low. It could be time-based lows. It's just any area of liquidity. So for example, let's say if you have a bull flag, right? That could be in itself some form of power of three because all that's happening is there is accumulation here. Usually this is going to happen above or below if you're bearish, but above some uh, higher time frame footprint or level, like a fair value gap or whatever. And usually the market will push a sharp down push into it, and then you will start to see a shift up in this area, and this is how we confirm that the market is distributing. And no, I'm not talking about Wyckoff distribution. I am talking about distribution to liquidity. So you have to understand that the market is always in one of these cycles relative to some defined range in time. Oftentimes, it is in, I won't say oftentimes, all the time, it is in multiple defined ranges of time. So, for example, let's say if you're having a bullish power of three on the daily profile, well, that might be just to fulfill the manipulation swing of a bearish weekly power of three. So, for example, let's say if this is what you're looking at as the daily and you see this bullish power of three, maybe that is just part of an overall, the weekly profile has accumulated, and then this big push up is all just manipulation on the overall week, and then the market is going to shift down, and it's the same occurrence you're seeing here, accumulation, right, in this area. Here, let's just draw it out so you guys can for sure see it. So accumulation, manipulation, and then distribution. And forgive my drawings, they're not going to be perfect, but we're not here for art. Um, accumulation, manipulation, distribution. This can be happening at the same time that this is happening on a larger time frame in terms of the bigger picture. So you have to understand that the market is always in multiple cycles at once. So what I mean by that is, let's say if you are in a manipulation cycle in a overall power of three on the daily profile, like this is just Tuesday, right? You're going to build this based on your bigger picture narrative. You're always operating a game plan within another game plan, if you're precise, right? So let's say if I came to the market and I had a bearish bias on this week because the overall, and this is where you use price, not just time. So let's say if the overall recent displacement maybe was something like this, right? You came into the market, the most recent displacement on a higher time frame, meaning a daily, is bearish. We got that shift in structure, or well, a break of structure right there with displacement. We've created this dealing range where the market is likely to go to a premium in different times of the week and then expand down towards this area. Now, a lot of like simple courses will just teach you that this whole range is just, that's just the order block, and you're looking for your overall, change of character, whatever in this. And that's the way I used to trade. But when you really want to be precise and you want to understand the market from a perspective of precision, you have to understand that these different occurrences in price are likely to occur at certain times of the week, day, month, or quarter. But understanding that any defined range in time that is relative to trading the concepts we trade can be used with this methodology. You're always going to see accumulation at or around opening prices. Now, this can be new week's opening prices, new day's opening prices, new month, quarter, new year's opening prices. It can be at session opening prices. That's why we look for price. That's why we look at the 830 and the 930 levels as areas of likely manipulation, because we know that there is an accumulation right before the equity market opens. And that's why you look at those as also time-based discount and premium. So we've talked about, we'll go into a whole nother, I don't want to get up too off track because I will. What I was trying to say is that you are able to apply this ideology to any defined range in time that is important. Now, I'm not saying you can just draw ranges on time and say, oh, I'm defining 2 p.m. to 3 p.m. They have to be defined ranges in time that are important to what we trade, right? And even more so, they have to be important to whatever asset you're trading. If you're looking to trade the Asia session with ES, you're probably not going to get accurate these kind of conditions because there's not a huge accumulation of liquidity at the Asia Open because you're not trading something that is traded during the Asia session, right? But anyways, let's say if you're looking for these occurrences in price, you're coming into the market and you're expecting the week to be bearish, right? Well, that Tuesday, oftentimes you're expecting to be bullish to put in the high of the week. And then once the market shifts down, then you're looking at the overall entire week to be bearish, right? And this is how we've absolutely killed options recently. I mean, last week we completely demolished SPY using this exact methodology, right? This is all it was. It wasn't anything special. And I'll go over exactly why we bought those calls. And it's super simple, but it does come from an in-depth understanding of what we're going over. So if you are able to look at the market from the lens that there has to be accumulation before there's manipulation, right? And the whole idea behind this, like if you're looking at a candle, right, and you're looking at how a candle is formed, what's happening here, a candle looks like this. Here, we'll just draw it out. Not any rush. So whenever you're at an opening price, the candle looks like this. It's just kind of moving around. It's bouncing around. It might go a little green, might go a little red. It's not doing much here. So let's say if you do have a big bodied candle to the downside, right? A lot of times a really I'm sorry, draw this red to not confuse. Let's say if you have a big bodied candle to the downside. Well, a lot of times if you look on charts, weekly candles that are very bearish, there's going to be a wick, right? Sometimes it's large, sometimes it's not. But if you are a seller in this environment, the ideal, hold on one second, guys. My daughter's in here. Hold on one second. Slept in. Had to get her settled. But so if you're looking to be a short seller in this week, right? Maybe you bought puts for the low of the week or whatever weekly drawn liquidity you're looking at. Well, obviously the ideal area to get in is going to be in this wick, right? So the way we do that is understanding when that wick's likely to be created using multiple different power of 3 concepts within one. So let's say we are looking at the week from the perspective that we're going to be bearish. We're looking for this to happen on a Tuesday or Wednesday, right? We're looking for that accumulate or that manipulation. Let's go ahead and I've drawn enough. Let's go ahead and actually jump on a chart because it's a lot easier to just show. So last week, right? We look at the market from this perspective, and you can see that it's not always as clear or picture perfect as what we just went over in terms of, it's not just going to be a barcode. I mean, this is fairly easy. So what I'd be looking at is the accumulation is going to be this right here, right? This range. Now, look, we open on Sunday night, we accumulate through Monday's session, and then we come up on Tuesday's session, we put in some equal highs, right? We didn't get above these highs. Very easy area of buy-side liquidity, right? Super. This week was very easy. So, and we start to shift down, right? We fall under this new week's opening gap, and we start to shift down. That tells you that the market is in manipulation, right? That can tell you that the market is likely to continue down. Where is it likely to continue down to? Well, here's where a basic understanding of price comes in handy. So let's say if you draw this right here and just use a premium discount, where is the market likely to travel? It's likely to travel to a discount of the range. Where did it go? Right to a discount of the range. If price is bullish, what's going to happen at discount? It's bought up, right? So after that, we're looking at the market in a possible bullish sense in these areas. We're looking at this as a overall reversal, so to speak, or a change in the state of price delivery. So if we are looking at the market from these time-based concepts, and we are, we're not just time, we came into the market, if you're just looking at price, you're bullish, right? So you're expecting a retracement down into discount. But let's say if you want to trade this with precision and, even though you're bullish, you want to take sells in a calculated way down to where you want to end up building longs. Well, you can look at the market from this lens that we're in a manipulation cycle and you are playing into that manipulation, but you're not going to overstay your welcome. You know, for example, just because we start falling out of the new week's opening gap, it's not like you're going to short and target the bottom of the range. So that would not make sense. Now, what could you short and target? Low hanging fruit, right? Obviously, you wouldn't have stops this wide, but if you came into the market and had a bearish bias, that can be very valuable for any day trader that is looking to trade just intraday. That's why we traded and had bearish trades on, I think it was Tuesday, right? Before I say that, let's go back and look, because I remember that we were looking at I could have caught, we ended up having a winning day, but it wasn't, you know, I break even stops too quickly. Let me go back and I'll pull up some of these trades in hindsight just to show you guys. And a lot of the time, whenever I'm looking at the market, I am using all of this in terms, was this the 30th? Yeah, that's what I thought. Go back and put this. This is on this day. So I was looking at the market as we're likely to be bearish coming into the marketplace because I was bullish on the week. And we had a sell from like the top of the day, which was like right in this area. But we ended up not holding it. I put stops to break even. Mistake on my end. Big mistake. But, you know, we still ended up making money that day off of other trades. Could have made a lot more. But the reason I'm bringing that up is that I use just that and in accordance with price action, breaking structure down, taking out these highs. All of this together can give you a very confident bias that the market is likely to go down. That doesn't mean you can't long in that down bias for scalps, but overall your bias is bearish, so it gives you a framework. So if the bias is bearish, we're looking at draws on liquidity that are lower, right? Here's low-hanging fruit. Here's our discount area, right? We have a fair value gap in discount. We see price came right to it and started to retrace the upside. So what you're going to look for in the market is whenever we come to any kind of discount or any kind of levels where you're expecting a possible reversal because the overall week is bullish, you're looking for this overall manipulation cycle to kind of start to fizzle out and start to reverse. Now, another way you can do this, let me go to 1 hour to show you guys this. So he's using standard deviations of time-based levels. So this is where it gets a little bit more complicated. Let's go to 15-minute actually to show. So whenever we're looking at where the manipulation cycle is likely to end, we can not only pair it with our overall price analysis and the overall day, which is usually Tuesday or Wednesday, where that's where we're going to put the low of the week in. If you go back over the last month, you can go. We've caught the moves a lot of these weeks, and this is just weekly one shot, one kill methodology, which is identifying where the low of the week is and switching your bias and looking to trade in that direction only after Tuesday or Wednesday. But one way you can project this, where this is likely to happen, is take a fib and look for standard deviations of the manipulation swing before we overall started to push down. So what I mean by this, let's say if we're in this overall little range, there's almost always going to be some kind of last little leg up before we start that manipulation cycle. If it was if this was a bullish scenario, like where the manipulation was bullish, we would look for a leg down, right? And you can see that whenever we're kind of identifying the overall key time-based manipulation levels, you're going to be able to draw standard deviations on these levels to project where the measured move in price will likely end. It's not going to always be spot on point, and but what you want to look for really is just seeing that fourth or this 2 to 2.5 standard deviations lining up with price levels. So the way I like to explain it is this is where you're likely to see some form of change of behavior in price, right? At the 2 to 2.5 level. Now, change in behavior does not mean reversal, right? In this example, like if you're looking at the market and you have obvious areas in discount, you're going to be overall looking for this area. The fourth standard deviation also tells you that whatever move is caused by this is likely to fizzle out around here and is likely to then return up to this original range or other time-based ranges, which is Monday's range. But if we're looking at, where's the market likely to kind of maybe change the state of delivery a little bit, which means instead of just expanding rapidly through the second to second and a half standard deviation, you're likely to get some kind of retracement here and come up and clear out some late trades. So this can provide long opportunities, and it can also provide you not getting stopped out on shorts or waiting for the market to show you its hand, right? So another way you can use these standard deviations is just like we use it there, you can use it on the manipulation swing, right? So what's the overall last move before we confirm that this is really the low of the week? Because we didn't confirm it on Wednesday. You can lean that way, and you can look for the market to, just kind of gets discretionary. I looked at it like, okay, we've reached 4 standard deviations, we've reached discount. It's very likely that the low of the week is put on this day. I'm bullish on the week. So I'm leaning towards the fact that it's, that's going to be the low of the week. But the way we confirm that is when we get a shift in structure up. This is exactly where we bought calls. If you go look, we bought calls. It was like 10:58 or something, right at the end of this candle, right? See, that's a 10 a.m. candle. The reason I bought calls right then was because that to me confirmed that the overall weekly power of 3 was in play. At that point, this candle right here, this weekly candle, looked like this. It was down, right? So if we opened here, right here, it's gonna be right there. We're gonna have a little bit of a wick to the upside to these highs, and the overall candle looked like shit, right? So what's gonna happen at this point is then the price is going to reverse rapidly. If I'm bullish on the week, where are we gonna go? Well, first stop's gonna be the weekly open, right? And on top of that, if you're bullish, where is price likely to head? Buy side liquidity. That gives you a very clear draw on liquidity based on time and price. Now, another way that you can look at this is you see that this last little swing, this was the last manipulation, right? You could also mark this out as well. What I like to use is the last manipulation before the overall shift happens, because that's really what we're looking at as high value. Because again, let's say if we're looking at everything in terms of power of 3, we're looking at this last little range, right, coming into that New York session as a likely accumulation, manipulation, distribution. Now, this could be of the morning session of the New York range, right? Again, you can use this ideology on any defined range in time. It doesn't have to be the whole week. It doesn't have to be the entire daily profile. It can be a session, right? It can be the morning part of the session. So if we see this manipulation swing, which is, quote unquote, smart money's footprint, we're going to look at that move to be reciprocated. So if you look at this and say, okay, what else do we have at 2 to 2.5 standard deviations? Well, let's zoom out a little bit. We have an order block over here, and we also had highs that were above the range. This was really just building into the overall bias that the market could continue the upside. Then if we look over here, we even had higher levels that weren't reached, but you look at this as more areas that this move has enough fuel to go to. So it's not like you would target this. That would be, you could, I guess. That'd be pretty degen. I did say, I said that, okay, the market could go to 4,300 a day. It almost did, right? Went 2 points away. If you go back in stock chat, I said that morning the market could likely go to 4,300 that day. And this is why I said that. Now, am I going to buy calls for that? No, that'd be, we had already bought calls, but on Friday I said the market was likely going to go to 4,300. Now, if you look right here, what is that? 42.43. Let's go to SPY, because I don't do really much analysis on SPY. I just get actual call or strike prices. So if you look, what was the high right here? 422.99. So I'm buying strikes for that, or I'm buying contracts for that strike, right? Very, very, I don't want to sit and say it's simple for someone who's not versed at all in ICT or some of the stuff we've went over, but yeah, you can use standard deviations, time and price to get a very accurate range, that whatever defined range in time. Okay, let me just re-say this because so you're able to use standard deviations for a price range that is likely to occur within a given time range. So for example, like if I'm looking at the power of 3 on a weekly profile and I'm able to identify kind of that last push before distribution begins, well, then I'm able to project where that candle is likely to end up at. What I like using is anywhere between 2 to 2.5 standard deviations. You're going to look for some kind of change in the current behavior of price. Now, is that going to hold up or last very long? No one knows until it happens. So you're just going to use these levels as somewhere to watch. Now, if you look, price did kind of reject from here. And I'm not saying it's going to consolidate on the higher time frames, right? If we're on a 1 hour and we're drawing out a weekly candle, you can see it's not a massive amount of candles. But if you'd go to this point and say, okay, let's go to a 5 minute, the market kind of did start to retrace, took out liquidity before it continued up. Now, the way that I like using the 2 to 2.5 standard deviation as low-hanging fruit, right? So if you were trading into that, like let's say if you came into the market and you traded NFP for whatever reason, you're psycho if you traded before it happened. I actually did trade after it happened, but you would look to be shaving off your position in this area. And if you go back, let me show you this picture. I didn't signal this because it was after NFP and I don't want people to get blasted, but let me find this picture of this execution. So people were like, why the hell did you sell it right there? Like, why would you do that? And the simple reason was because I looked at the market as it was losing steam after I already met this 2 to 2.5 standard deviations of the expected move based on the last manipulation before the distribution phase began. So hopefully this isn't like too much. I know it's kind of like more in depth than I try to simplify everything, but I'll just be completely brutally honest with you. There are some things that are very hard to simplify because they are complex in their nature, but it's not necessarily I don't want you to be discouraged and think it's too hard to understand, because I know that that's how I used to look at a lot of this stuff. But if you are able to try to compartmentalize each part and really just conceptualize it, that overall everything that you're doing in smart money is trying to track manipulation. So if you're basing everything around that, well, understanding where and when that manipulation is likely to occur based on time gives you more of a mechanical edge than just using price, because price candles are printing all the time. And you can see, if you look hard enough for some kind of occurrence in price, you can find it whether it's there or not. But time is time. You can't say it's either fucking Tuesday or it's not. You know what I mean? That kind of adds a mechanical edge to a quite discretionary strategy. Now you can use this with all sorts of things. Like, for example, like let's go back in to this last day. So this is the overall day of Thursday. Now, whenever you look at, if any of you guys have followed ICT extensively, I'm sure you've seen the classic buy day and classic sell day templates. I just fucked that up. Which they look like this, right? Right, and it's a little different. More like this. So it's basically that, the accumulation is right here, manipulation, distribution, and then we come down and consolidate for the close. So let's look at this right here. What does this look like to you? Right? So you're able to use these overall same ideologies through and through. So what is this right here? It's going to be the New York session, right? Now you're going to see accumulation right before institutional order flow opens up, which is at 7 a.m. It is the old school ICT kill zone. It's not something I'm necessarily looking to trade, but you'll see this accumulation. You get a manipulation down, and on top of this, you are already bullish, right? You're already leaning bullish because you have made what you are thinking is the low of the week. You came down to 4 standard deviations. You're in a discount of the 1 hour range, right? So you're leaning bullish, right? So once this happens and you start to shift up after, once this happens and you start to shift down and then shift back up into the range, at this point, you're looking to be a buyer. And this is based more off of time and price together, but more off of time, because let's say if you were looking at this just from the market open, so ICT stuff, market opens, you go up, take buy side, a lot of people are going to want to sell here into the lows, right? That's the 2022 model. Is look for the price to rush up at the open around 10:30. You're going to get, or 10 to 10:30, you're going to get a reversal. And that model does work very well when used properly. But this is a great example of how to not get eaten up in that, right? Because at this point, you're looking at the market as likely bullish based on the weekly profile, and you're also seeing accumulation at opening prices. And if you are bullish, you want to see manipulation down first before a push up, right? You can see we moved where? Right up into 3 o'clock and then came down, consolidated for the close, right? And if you look on your charts, you're going to see this over and over and over again. Now, does this only work for indices? No, this can work for euro dollar, it can work for anything, but you want to use it at the right time. So for example, if you're looking at euro dollar, this is the kind of price action you want to see during the Asian range. This is what you want to see during the London kill zone, and then an expansion into the New York open, right? See if we can look at some other examples of this. And another thing you can use as well, actually, but I'll throw this in there, is new day opening gaps. Let's see if I don't know if there really was much of one. And you don't want to use these if there isn't Like this I wouldn't use. There's literally barely any difference, right? Or wait, is that even where it's at? I know. Sorry, I'm looking at midnight price. My brain's fried. This is Thursday, so we'll be looking at Wednesday, transition, Thursday. Be back over here. Would be right. Yeah, there's no gap really. I wouldn't use a gap that small. So I can travel around and find one that is a little bit better to use. The new week's opening gap. Here, let me see if I can find one that I'm gonna throw some lines on the chart. Basically, what I'm trying to find. Wait, here might be one. That's weak. Fuck. And you don't ever want to map these on a 15-minute. I'm just looking to try to find obvious ones, because then you want to go down and map them on a lower time frame. Bear with me for a second, guys. Okay, here, let me do this. You still want to go in the lower time frames, and well, here's a great one. I know that's going to be a good one. So we'll go back. We'll just look now in a 3-minute or a 5-minute. I like using a 3-minute on these time frames. But if you look here, you're going to want to mark these areas out and watch price as it comes here relative to, okay, here's a great example actually. So, okay. So just like we were talking about before, you want to use price first off, right? We go back to, let's say, a 15-minute. You know, I think that it's pretty clear price is bearish in this example, right? We massive displacement down right here. You have a dealing range, price has traveled up and then shifted down. This tells you just off price that you're bearish. So what are you going to look for around the open, right? Which is, if you're looking at New York session, you want to look around 6 to 7 a.m. I'm not talking about equity open. You can look for that as well. But really before that, because what you're catching with the ICT 2022 model a lot of the times is just the overall rebound of the big move. So, you know, whenever the Judas swing, so to speak, which is the push down that gives you, like, you know, your ICT entry model, which would happen here, or you trade up into this, you can also get trades into that, right? And that's kind of the trades that I've been taking recently, using a mix of different things, is mainly bias and time. But if we look here, you see this accumulation, right, coming into that 8:30 open from the 6 to 7 open. So we accumulation in this new day's opening gap, and we manipulate to the upside. So for example, if you see this, right, that's going to automatically give you a bearish bias. The reason for that is if you're bullish, right, on like the day, or if you're bearish, or let's say if you're bearish on the day, and you're looking for this low right here, and you start to see accumulations around opening prices, which is the new week or new day's opening gap, and the overall the session you're looking at, and then you start to see the first big push is to the upside that manipulates this range, right? Because this isn't displacement. This is kind of just inching around. First big push pushes up to this range, and then you start to expand back down into the range, right? That in itself will give you a bearish bias. So for example, if you come into the market opens right here, and you might have caught a sell up here if you're really aggressive. But if not, when you come back into this fair value gap, you're looking to sell that, right? Where are you going to sell it into? Either this low or continue selling down into lows until the market gets back above this new day opening gap. Because if you look, this almost acts as some kind of resistance in a way, and you just continuously kind of chop around, take out a high, shift down to a low, right? You come back up, take out this high, shift down. Where do you go? Down to this low, right there. And the market comes up, takes out a low again. You can see the market's just rejecting off this area. I'm actually curious. I want to draw a standard deviation. Go to a 5-minute on this little manipulation swing. I would say that, you know, the market kind of pushed up, pushed down, and then here is the real like manipulation overall. And look at that, 2 to 2.5 standard deviations. That's where you look to see a change in the state of delivery. Right? I'm telling you, it's actually insane how well this kind of stuff works. But it's really based off of using time-based manipulation swings, and then calculating, just using, I don't even say calculating, it's not like we're really calculating fucking anything. Projecting a range based on the manipulation that occurred during the manipulation cycle. But in order to understand that the market is in that manipulation cycle, you have to look at it from a time-based perspective, right? So I could beat on a dead horse for forever, but I pretty much went over everything that I want to go over. So if you guys have any questions, I'm going to put my headset on. Should be able to talk in this chat. If you have any questions, you can ask them as well. Okay, I'm just now seeing this. Ayana, this is a different chat, but if you go to the early bird stock stream, there's actually a open chat button on the button you had to click to join here. But your question is, can I explain playing options OS? Okay, using weekly profile, power of 3. Okay, so hopefully this already explained that because that was a little earlier. I didn't even see this question, but really, if you're trying to play options like weekly, catch the move of the week, low-hanging fruit would be wait till the market is on a Wednesday or a Tuesday or Wednesday, and it starts to shift up. We'll go back to, let's delete this. So, for example, if I'm bullish on this week due to this range, and that's the daily displacement is bullish, right? Overall daily displacement was bullish right here. You're going to be coming to the market looking for us to trade down to this daily fair value gap, put the low of the weekend on a Tuesday or Wednesday. So if that happens, start to see this, if you're really aggressive, you can try to buy options as soon as you're anticipating the low of the week. But what I recommend, so you don't get theta burned, is waiting until the perfect moment. You want to wait until the market is literally just shifting up, because then you're going to get theta burned less, and you kind of get IV on your side. I'm not like an options master just yet. I've definitely learned a lot in a short amount of time in terms of, which contracts are good, which aren't. But my opinion is waiting for this shift right there. You know what I mean? And that after you've put in the low of the week, as soon as you shift up, then you could either say, okay, well, I'm going to buy calls with a strike of the weekly open. That'd be low-hanging fruit. You could buy at the high of Monday. Or if your overall analysis is putting in, other strike points, maybe you're another way I've been exploring is buying for just the two standard deviations above this, right? But it's kind of hard to do that with SPY because I don't like using this kind of stuff with SPY, because SPY is just a nice vehicle to trade ES. You could also maybe do it on SPX. I haven't done that, but really the main three methods, I guess, would be waiting for the weekly power of 3 to play out and confirm, immediately buying strikes for a week out of the Friday. So for example, like this one, I bought them for the 8th because that Friday was, not a week out from Friday. I'm sorry, a week out from the day you're buying them. You can play around with it as well. I'm still kind of messing around with that part of it, but get them for like a week out, unless you're really trying to be some degen shit. You can buy them very, with a maybe a 0 day. I don't know. That'd be crazy in my opinion. About on Thursday or maybe a Monday expiry. That could be the better way. I'm still kind of messing around with that. But just don't buy. Don't get theta crushed or theta burned. But really, the overall strike strategy is using the open, the high of the current week, or 2.5 standard deviations. Now, the best way to do this is to try to look back and, like, let's say if there was some high resting at or equal highs up here, then I probably would have bought strikes for that level. But we didn't have that, right? My daughter's funny. Okay, give me about 5 minutes and I'll be off here. Okay, baby. Can I take a quick look at dollar and gold? Sure. So, dollar. Overall, using the strategy that we've been using to pretty much, we haven't messed up on dollar much. I thought we were going to continue down here. I was wrong there, but we basically, as soon as this sweep happened right here, we called this high, we went to it. As soon as this sweep happened, we called this low, we went right to it. So if we're continuing to use that strategy, the overall draw on liquidity for the dollar would be on a weekly chart. Not for next week, but using this chart, a weekly chart would be this high. And then if we're looking at the daily, draw this, I don't know why TradingView does that. But if we're looking at the daily, we look at this level right here. You can also kind of draw standard deviation. If you look, that manipulation swing, which is kind of what began this right here, because we don't take any lows after that, and we started expanding. That level, I think is likely. You could also, if you're using order blocks, just the bodies, the 2 to 2.5 lines up pretty nicely. So me personally, I'm still bullish on the dollar at this moment. We did see the market kind of retrace a little bit from this fair value gap like we were talking about last week. But if you're looking once I'm bullish, I'm looking at bullish order flow. So I see a bullish order block. What happened in a bullish order block? Shift of structure, right? Another way you could look at this: accumulation, manipulation, distribution, right? Now this isn't really as time based as much, so I wouldn't mess with it too much. But more or less, I just look at it like bullish displacement to the upside, right? This high to that low, or sorry, this low to that high, discount, order block, overall draw on liquidity above. Low hanging fruit for me be here and here. So I'd be bullish on the dollar. Also, here's another thing you guys gotta remember. The debt ceiling bill. I mean, I would imagine that tomorrow is going to be it could be priced in. Do not go in here and try to trade based on this. But I would imagine that when this opens up, we're going to see something. We're going to see movement. So just be very mindful of that as trading anything. Now, gold, on the other hand, we're kind of just coming down. Not really tapping into this level as much as I thought we would. Right, we took it all this trend, or not as much as I thought we would, as much as I think we will. I think we're going to go deeper into this level down here. And again, really just kind of take that day by day. The dollar's going to be crazy. What I would like to see here is some kind of push down deeper into this level, maybe even market maker model into it on the higher time frames. But overall, I'm looking for a 1932 on gold. Euro USD and dollar CAD. On the euro, using this strategy, I would be looking for this low. Overall, on top of that, that would be this. I don't know why TradingView is doing that. Pretty annoying. Overall, I'm looking at it as okay. I mean, we have something up in this area, but order block right there. Market traded into it. Shift down, right? So I would expect probably bearish weekly power of 3. I mean, that's what I'd be leaning towards on the euro. But now, if the 1 hour starts to shift up aggressively, right, and we do not see this followed through, I would look for potential reversion up to more of a premium of this little move down. That's not here yet. Dollar CAD. I haven't looked at this one in a couple of days. So I haven't really liked this chart in quite a while, to be quite honest with you. Just not really following what I usually look for. Overall, though, I mean, I would almost say bearish because it's failing. I mean, the way I look at it usually is like, okay, bullish displacement. We've got a bullish displacement, right? This would be overall our range, right? Coming into a discount, starting to push up, but we're failing to take out this high. So at this point, I almost want to look at this as a draw on liquidity. And you're looking at the bearish order flow is being respected. So this is what I talk about in my bias video. Whenever it's hard to develop a bias, sometimes you can just really look at like what order flow is being respected, right? This order block is definitely being respected, in my opinion. I mean, I think it's that, we see this nice push up into it. Another way to look at this on the weekly, let's see. Let's look on a daily. Oh, that's so fucking annoying. Why does it do that? There we go. So order block being this massive push up here, you could maybe refine this down. Yeah, I'm not really seeing the advanced market structure stuff. I was going to see maybe if we made a high, and then a lower high, but we didn't. So that's no dice there. Yeah, I don't know. Personally, this is a chart that I'm chilling on for a while. I usually like trading dollar CAD, but it's not really, what, my normal cup of tea. And also, yeah, high, that gold limit's going to be canceled. It's funny you said that. I have that on my Asana to do that at the end of the stream. I have an alarm set to cancel it as well. Of course.
Were to do it like intermingling the one shot one kill with like the classic buy day and just holding it for a day trade with options, you never really go down further than the 30-minute for that. You were just looking for that market structure shift on the 30-minute and then look to enter there.
Okay, so if you're trying to day trade options like using 0 days, so let's go back to ES for a second, and I would more or less try to find like the intraday draw on liquidity. I think we were on just ES. So let's go like back in here. So like let's say if this happens right here, and your overall you have that one shot, one kill, target for the week, but you're just looking to buy like an overall daily contract. The way I would do that, a couple ways. It's the same ideology really, but maybe look and say, okay, where is 2 to 2.5 standard deviations of this manipulation during that session? So let's say if once this happens right here and you shift up, at this time you could buy 0 days for the high of this range on SPY, or if you want to be a little bit more, kind of degen, you could look for what's standing at the 4th standard deviation, since you are trading within the weekly bias. So for example, like let's say on this day, it's Thursday, you get that push down and a shift up, and you're saying, okay, well, the overall weekly profile is bullish, so I could maybe be a little bit more, degen, I guess, with my targets. You could target this high over here because it's lining up with that 4th standard deviation. For a more conservative approach, you would just target the highs of the little accumulation before, or just any other areas around that 2 to 2.5 standard deviation range. And you can also just use kind of lower time frame structure to do this. But this is how I would do it. If I'm looking here, I'm saying, okay, I'm gonna buy 0 days. Let's go back and look at SPY, because if you're buying SPY options, at that point I would have looked at this right here, 419, as a like if I'm down here, I'd probably just buy 419 or 420 0 days, and try to buy them at the last possible minute, because you want to make sure 0 days that you're getting, burned by theta the least amount possible. So that's how I do it on this day. It's not always going to be that clear, but you can, another way that you can do it, another good strategy is, let's say if you're on a Friday, let's go back to ES. I always do my analysis on ES, but let's say if you're on a Friday, like the week before this. So this Friday, let me mark out last week's open. So Sunday. So let's say on this Friday right here, I was bullish on this week, right? In order to have a bullish weekly candle, you're going to have to go back above the open, right? So on this morning, you could literally just buy strikes at the opening price. Or if you want to be a little bit more, degen, you could target the high of the week right here. Or whenever the previous week's high is really close, you could also target that. They wouldn't have won the money, but they would have definitely made some money. Let's see how the standard deviations worked for like that morning swing. Let's go to like a 5-minute back then. Wait, I go too far. Yeah. So let's say in the morning, not really much of a swing there. At this point, I would be looking at this. The accumulation would have happened up here, manipulation, and then the distribution that kind of started that daily cycle. So I would look, okay, what's this right here? And at that point, you can see the market started to shift right around that 2 to 2.5 standard deviations. But you can use these combined to say, okay, at this point, I would just look for the weekly open. You know what I mean? That's on SPY. That was probably a decent move. Let's go back to SPY and just see what that'll look like then. The weekly open would have been, I think, my daughter was, I thought she was asking me something. Monday, or sorry, I'm looking at the wrong one. I never really do this on SPY. You could just do the weekly open on SPY if you wanted to be a little bit more Conservative, so that'd be 418. If you're coming to the market down here, I mean, if you bought 0 days, $3 out of the money, you're gonna make good money. Those are the ways that I would do that. If you're trying to day trade within that overall framework of the weekly one shot, one kill. The daily, I would just be using, that to build a bias of which direction you're looking for the market to go, and then use that little power of 3 at the beginning of the New York session in order to determine or kind of confirm the time to buy your contracts, and then use a standard deviation for your targeting, aligned with price stuff.
Okay, thank you so much. I did options for probably like a couple years back, and I got burned because I could never pick the right contract. It was either too far out the money or too in the money, and delta would be kind of harsh, eating up my my premium. So it looks like you're going a little bit further out the money, right?
Yeah, I for 0 days, my strategy is buy them extremely far out of the money and buy them at the absolute last moment before the price starts expanding.
Okay,
Yeah,
thank you.
no
And
problem.
can I ask, is there a reason why you don't go closer to into the money?
Just in my opinion, the risk to reward is 0 days. If I'm playing a 0 day, I need that to move a lot because I'm not putting much in it due to the high risk nature of trading 0 days. So if I'm trading a 0 day, I want to be giving myself a high potential for a big profit, right? I'm not gonna put a bunch of money into a 0 days, so I don't want to get contracts that at best are gonna move, you know, 50 to 100%. I want to trade something that's going to have the possibility to move, 100, 200, 300% in the same day because I'm risking such a small amount.
Okay, I would probably do 1 or 2 days out because I'm really conservative.
Yeah, that's cool. Yeah, that's totally cool. You could definitely do that, or even trade the ones that are a little more like the weekly ones. Those obviously will move less, but in terms of like contracts, like this past week, we got weekly ones that moved 400%. So it's really just a matter of identifying when there is that room to run, when there like let's say if the market was right under this open and that little move pre-market was barely anything and there wasn't much room, I probably wouldn't look to buy 0 days or trade that day. You know what I mean? It's kind of really identifying with options. As far as like short-term options, it's like you got to really know, it's all about timing and knowing your potential ceiling. Because if you're like me and you trade options with the mindset that, hey, I'm not putting really more on this contract than I'm willing to let expire worthless, then you gotta make sure you're operating in the right conditions.
Okay, I will play with that this week. Thank you so much.
For sure, no problem. Also, Zach, I'll take a look at XRP. This will probably be the last thing I do. I gotta get going. Um, XRP real quick as well. The weekly on, oh wow, it's flying. I mean, you guys have heard me. I've been talking about XRP for a minute now. Like everybody was, like I used to say, like everybody clowns on certain trades, but like this shit's going to $1 in my opinion. At some point, I know that sounds, people are like, what? That's crazy, but it's the way I see it. I mean, low hanging fruit at this point, in my opinion, would be this 58 cents, more than $1. I mean, who knows? I could say the weekly chart looks insane, right? It really does. Everybody clowns on it, but it really does look extremely good. But yeah, I'd say weekly or low hanging fruit 58 cents. This fair value gap looks likely as well. We also got a breaker right here. I would say the next stop actually after that is going to most likely be this breaker, which is that 62 cents. I'm not saying you're just going to go straight to $1, so no need to say that I said that, but overall it looks really good. I think before you hit $1 though, in my opinion, you're going to see a lot of chop, a lot of turns down, because guess what's going to happen? Just like what happens right here, everyone's going to buy it here, then they're going to get stopped out or be underwater. Just like everybody buys it here, they're going to get stopped out or be underwater. Just like everyone's going to buy it above this high. I mean, it's just the nature of things. Yeah, going to be a long time before $1. I agree. Market maker buy model in Euro USD 4-hour chart. No, I do not see it at all. To be quite honest with you. Yeah, I don't see it. On that note, guys, I'm gonna hop off here. I got to get my little one ready. We're gonna go out and do some stuff today. So As always, I appreciate you guys. If you have any questions, DM me, at me in chat. You know, guys, I'll try to be as quick as I can. It's probably better to at me in chat because the DMs would get pretty fucked up, and it takes a little longer to reply to them. But yeah, I will see you guys most likely tomorrow. I'll have a schedule posted up later tonight. It'll be tomorrow and Tuesday. After that, I am gone for the week. I'm going to be in Miami. So yeah, I will see you guys then. Peace.